Welcome back. Nifty 5982 futures, that is. You've got Bank Nifty futures which are down 1% or so. So it's a pretty decisive turn down, 11,144 or so. And what's happened across the board, especially banks and Bank Nifty, is that stocks opened up and most are down between 1 and 3% from the gap ups. Hardly gap ups, but whatever they opened up with, they've lost and then given up some more. Rajat Rajgarhia is joining us right now, Managing Director, Institutional Equities at Motilal Oswal Financial Services. Rajat, we are in a strange kind of situation where, the RBI is acting decisively, is looking at, long-term stability. It's saying, well, we are ready to bear the short-term pain. But it's at least perceivedly, it's causing more damage. What's your sense, Rajat?
Hi, good morning. Well, I think it's no more a short-term pain now because this is going to be the third consecutive year of a low growth now. In the last 2 decades, we never had 2 consecutive years of falling GDP growth. And this time we will have a third year of growth, which I think now the new estimates that will start coming out for the GDP will be closer to 5% again, anything between 5.5. So I think the pain is lasting longer now, and slowly, the more you stay at this 5% growth mode, you will see more and more macro numbers of the sectors getting impacted, and that is what we are seeing into the markets now. You have an IIP growth which continues to remain in a negative zone. You have a services sector which is still coming down. You have rates which are remaining high, and you have currency which is out of control. So I think we don't look at it now no more as a short term, because we have remained at this painful period now for quite some time, almost 1.5, 2 years now in the fray.
But it's continuation of what has been going on, right? An extension of what has been going on. And markets
yes,
react markets react to the future or the perception of the future.
Yes, and I think the more important point is that whatever ticks of changes you are seeing into the estimates, whether be at the GDP level, the earnings growth level, or the target prices level, all are still coming down, right? So you may have some stability in a. There's one way to look at it, that the GDP number is stabilizing at 5.5, but that number itself is quite bad for us to remain at for 2 to 3 years in a row, and our fear is that this year we will see that number remaining in this band, which would mean that the element of slowdown will spread to more and more sectors in the quarters to come.
Is there any silver lining, Rajat, as you see it?
Well, the silver lining is that at least the broader markets are refusing or at least the benchmark index is refusing to go down. Every time, we have seen a real bunch of negative news over the last many quarters now. And still you have an index which is very close to 20,000. So maybe the markets are saying that a lot of these bad news have remained for some time and have got well factored in. But I think the other silver lining is that whenever you have situations like these, when the growth takes a big knock and suddenly you see problems of currency coming in, you basically see a lot of acts coming together. So I think while last evening's FDI hikes may take their own sweet time to bring any worthwhile flows, you will see a lot more measures being announced by the government. And slowly these measures being put in practice will help us come out of this slowdown. But yes, right now there is no overnight formula to work on to come out of this slowdown. It has to be a painful recovery.
You said, I guess in a lighter vein, you said the index is still there, right? Close to 20,000. And that maybe is a silver lining, despite all the negatives we have seen. But that also is maybe one reason why upsides are capped. And we essentially are always looking behind our shoulders to say, well, how large the downside can be, because prices, in a way, remain excessively high as measured against actual growth on the ground, for whatever reason. Do you agree with that, Rajat?
Well, yes, but I think the more important point is if you break this market into two segments. One is some of the companies which are still growing or the balance sheets are still very comfortable, and I'm particularly referring to 3 or 4 sectors which have been the highlight, like consumer, pharma, technology, Reliance for that matter, joining this group now, and some of the specific private financials like HDFC Group. They have continued to move up, right? And they have seen good element of re-rating during this period. And then you have the other part of the market, which is financials, capital goods, some of the auto names, which are continuing to make newer lows, few on prices and few on valuations, right? This is the space which is getting impacted more because of the domestic slowdown. So that's why, depending upon what view you have on the market, right, you pick up between these two spaces. The second space has got significantly knocked down. If you look at many of the stocks, they would be down 20-30% from their highs in absolute terms, and maybe more lower on the valuation terms. And on the other hand, you have the other space which are trading at almost at the lifetime high prices and the multi-year high valuations. And that is making the markets remaining stuck in this range, because of which the absolute level may look high. But one other point that we need to know here is that even though for 6 years the markets have remained in this range of 18 to 20,000, right? The earnings CAGR has been about 7%. So every year there is a de-rating of 7% which has been happening into the markets.
Yeah, that's an interesting point. Just a quick thought, Rajat, on private sector banks, because that again has been an extremely strong corner of the market, right? They've commanded big premiums over, huge premiums over the PSU peers. Is that game over now, according to you? And would you say private banks like Axis, Yes, Kotak, IndusInd, etc. would see absolute downsides from where they are trading now?
Well, I want to bring two important points in this regard. First is, if you look at the way the PSU banks have got significantly derated, and rightly for the kind of numbers or stress assets that they have reported, till the last quarter, which is the March quarter, the private banks were continuing to report one of the lowest credit cost and the highest ever profit numbers that they ever reported, right? It was almost looking like the PSU banks are operating in a 3 to 4% GDP growth environment, and the private banks were still operating in a 7 to 8% plus kind of a growth environment. The latest round of RBI moves that have come, I think this is not going to just alter the growth or the pricing dynamics only for PSUs, but will also alter the dynamics for the private banks. That is one. Secondly, if you look at the FII ownership in the last 4 years, when they have pumped in $70 billion in India, 33-34% of that money has come into private financials and NBFCs like HDFC, IDFCs, etc. Right? If at any point of time they take a negative view of the overall growth, they basically own these private financials in very, very large quantity. So that is one space which will see selling from them. So I think continued moderation of macro growth and significant over ownership of these stocks by the foreign investors would make sure that there's a good chance that you will see now some more correction coming into these private financials. But yes, maybe when this correction phase is over the next coming weeks or months, and as and when you start getting less negative on the growth, again these will be the stocks that people would like to start chasing again.
Right. No. So to my question, whether these private sector banks that are listed out, these 5 or 6 names, have absolute downsides as you see it, right? From here, the answer would be yes. And I'm talking about a medium-term perspective?
I think in the short-term perspective, yes. But as I mentioned that these banks would still be able to handle the environment very, very well. And as when you see these fears subsiding, once you see this correction, because a lot of these stocks already corrected 7-8% yesterday, and another 7-8% correction, and suddenly many of these stocks will start looking quite good. I think you will have more people who would be looking to buy these stocks lower if they correct further from here.
Right. Okay. Got that. What about NBFCs? How hard will they be hit, and which ones in particular? I mean, and a comment on housing finance companies as well, where margins are already quite low.
Well, I think on the NBFCs, that is definitely one space where we should be quite cautious on, because we know almost all of them are wholesale borrowers, and the intent of RBI is definitely to make the rupee or the domestic loans, domestic borrowing costlier in the short term. So that is going to have its own impact. And on the other hand, the pricing of the assets is not something that only NBFCs will decide. It will be decided by the banking system in whole. And we had a whole bunch of PSU banks yesterday which came and mentioned that they are not looking to raise their lending rates. So I think NBFCs as a pack will definitely see a negative impact on their margins. And to some extent, I think you will see moderation in the growth rates also. So I think you will see a continued period of derating of some of the NBFCs, because they had been performing very well, just in line with many of the private sector financials, right? That is one. Second, on the housing finance companies, again, the margins for many of them, at least on the individual loan side, has been shrinking, and this measure will put some more pressure on them. But yes, we will again have to watch out how players like HDFC, etc., deal with this environment, because they have gone through these periods many times in the last decade or so, but they have still been able to protect their spreads quite well at 2.1, 2.2%.
A lot of all these things will depend on how long these measures last for, right, Rajat? These RBI measures. What is your sense?
Well, I think we were definitely surprised by these measures, because while at some point of time the noise was growing in the region that Brazil, Indonesia, many of them are now following a monetary tightening process to curb the currency volatility. In the case of India, the debate till very recently was, when will the next rate cut by RBI will happen? And suddenly you take a big U-turn, where from a rate cut now the probability starts rising whether the next event is going to be a rate hike or no. So I think now everyone in the market will just keep a watch on currency, because if after all these measures that the government and the RBI has been taking, if you don't see any respite on the currency, then I think RBI will have no choice but to come up with more steps, right? We would like to believe that some of these steps are more short term in nature, but that's more of a hope, because right now there are so many variables which are driving these trends, right from global volatility to the domestic slowdown. And then you have an election period in the next 6 to 9 months coming up, any state elections from November, December, to central elections in May, right? My more important worry now, which we have started to discuss, is how does this another year of 5%, 5.5% GDP growth going to impact the revenue collections at the government front, right? Because that will again start becoming a noise for the market at some point of time, that you have subsidies which are going to get higher and you have revenue collections which are going to get lower. So how does the balancing on the deficit happens? And that will also have an important bearing on the way RBI will decide about their course of action.
Yeah, no, absolutely. What does one do in an environment like this? where there are very few, if any, silver linings at all. There are elections in 2014, before which, I mean, there will be little interest in terms of actual investments on the ground, etc. I mean, that's understandable. Even if you do FDI, etc., open up limits, A, growth is not that strong, so it's not attractive. B, you got elections and a regime change possibly, so people would like to wait. So, what are you asking and telling and advising clients to do in the meanwhile?
Well, the one common trend that we have been seeing from clients also, and what we also articulated in our last report, is that it is advisable to be quite closer or as closer to the index as possible, because while we know that there is a lot of pessimism in the markets on the whole right now, it is right now going to be quite brave enough to start looking at individual stocks and start picking up some of the very beaten down name. So I think largely try to be indexed, and then within that there are some pockets of stocks which have now, after being in a period of prolonged no growth or declining growth, are looking to come back in a growth phase. I think that the three most prominent names that comes to our mind, first is telecom, second is Reliance, third is ONGC. Besides that, technology, because the valuations in absolute terms still trade reasonably discount to their long-term averages, and currency, we think, will remain in this weak zone, will help drive some further outperformance into these names. And into the rest of the market, it is better to be as closer as one can be at the index level, or sorry, at the index weight.
The index, okay. Got that. Thanks very much, Rajat. Great to have you with us here. Appreciate those thoughts, and I hope we can do this more often. Good to get that perspective from you. Rajat Rajgarhia at Motilal Oswal Institutional Equities with his thoughts on the market. I'm going to take a very quick break here and come back in 2 minutes. So Nifty futures are up at about 5983.